So hello, and I welcome you to today's live trading session. Discover tactics of discretionary and quantitative pro traders with Stefan Friedrichowski and me. We both want to give you some insights of in our trading and what we are looking for. And we already had the pleasure last week to talk to each other. By the way, can you see my screen? I hope so, right?
Oh yeah, everything is right.
Okay, this is, by the way, Stefan. Hello, Stefan. How
So
are you?
yeah, hello to everybody as well from me. So we have two sites in Germany, one in Berlin, Jens, and me in Dresden. So welcome everybody to the next trading session from my end as well. So go ahead, Jens.
Yeah. So what we will do today. So first of all, I have put together a small agenda here, and in fact, we should hurry up a little since today is we just have 1 hour, and I think we have plenty of stuff to discuss here. So first of all, make sure that you understand that trading foreign exchange and CFDs on margin carries a high level of risk, and that the discussed products may not be suitable for all investors, and that you please ensure that you fully understand the risks involved. And then very rough, the agenda as already last week presented. So first of all, there is still a very special offering from JFD. You can find the banners on the website from FX Street, and you can also find the link now in the chat box. It will be published from FX Street. So and in fact, you have to hurry up. So last week we had 300 spots left, and we made kind of early bird thing with here the with our first part, since the banners went live on Wednesday, so the day after we had this webinar. And right now there are only 28 something like this slots here left. And so yeah, and in fact, it's a very, very, very special offering from JFD here. It is it's, by the way, in 10 hours around it will be over. So you have 10 hours to at least register. So the special thing about this is, by the way, and this is something I've presented already last week. So you have the chance here to save your place, and then see whether, by the way, I've prepared something for this, so probably we'll use this one here. So you can register now and reserve your account offering for 1 month. That means you can check out JFD, why JFD should be your first choice, and then decide to open an account within the next month. But again, and this is the thing, after 300 account openings, the offer is not available anymore. Meaning that if you just see below 30 offers left here, that means that if you wait for too long, then probably your spot will be taken by someone else. Yeah, and so that's everything I have to say on this offer. I already said it's a very, very attractive offer for EA traders. And for any information on this, just check the banners on FX Street, respectively. Check the link in the chat box here in the YouTube channel, where you may listen to this event right now. And now let's come to the topic of this webinar here. So the thing is that the header of this webinar, by the way, here, you can see it already. So that the discretionary and quantitative pro traders we're talking about. So discretionary, because my trading style is to some extent quantitative as well, since you have to look up a statistical advantage in your trading. You have to have an edge, and this is what you try to capitalize then. But nevertheless, there is some discretionary touch to my trading. While, for example, Stefan is using a very, very quantitative approach, and you will see what I'm talking about here a little later on. And what I just want to present to you, since we're about to see the market opening here of the US markets in around 30 minutes, so at 1:30 p.m. GMT, I'll give you a setup here, which I usually use. It's a very, very rough setup. in fact. And then based on this setup, I then try to position myself based on my discretionary touch, let's call it here, based on my personal picture. I now draw on the US equities in this case. Stefan will present to you about the DAX here, but I think you can easily adapt this to the US markets. And in fact, this strategy, which I will present to you right here, and which I will, or based on which I will show you a setup, which is potentially tradable then for today. This will be something we'll have a deeper look at a little later in this series here. So in part 4, there will be a time when Stefan will give an outlook here on this strategy. By the way, if I remember right, Stefan, and you already automated the the open range breakout strategy, right? So with some personal parameters, but all in all, I think you already trade something similar.
Yeah, I trade something similar, but one is simply the DAX seasonal we will have today later. And what I do quite similar is a open range breakout on a couple of Forex pairs at a different point in times during the day. But the overall logic is quite similar, I assume, to what you will present right now. But as discussed earlier, what I will do during the next week until our next webinar next Tuesday, I will try to have a more in-depth look to especially your strategy and create an Excel sheet in order to prove your edge, your statistical advantage, and then we can finally do something completely automatic on that strategy as well. But let's see. I don't know the results already today, but that's on my to-do list until next Tuesday. And then we will see within an Excel sheet how the strategy performs during the last couple of years.
By the way, I definitely look forward to it. So the thing is that based on my personal trading journal and everything I wrote down over the last years when I traded the strategy in the market here, I have a positive outcome on this. And I'll be really, really interested in how my, let's call it discretionary approach or discretionary touch works. Since I think if you just put in those parameters here, you probably, well, I'm not even sure. Probably the result won't be so outstanding or something, but the discretionary touch, I think, can make things a little more interesting. I think the seasonal, for example, you will present a little later, is something I was somehow really excited in the morning, since that was something I hadn't on my agenda here, based on the 40 exponential moving average, I think, on a daily chart, and the reverse days you were discussing about. So I think most of the participants probably right now say, "Oh, cool, that sounds great." Yes, it's definitely great. But I definitely look forward to it. So what your Excel sheet will show us here, I just hope that it won't look so bad.
But the good thing is that kind of mixture you trade is something I really appreciate. To have a common setup, a base setup like what you have here, and you will explain a little bit more in detail now, but to have an opinion as well. And that opinion, like, hey, market is going up, oh, market is going down, so that you have something like an edge for the preferred direction, or even to say, no, today is not the day for this strategy. I like that kind of combination of a base setup based on rules, and secondary then to have that discretionary touch to say yes, no, or only one direction. Perfect.
By the way, today is a perfect day to see that discretionary approach. So I've made this a topic in the morning meeting. So we've seen the market breaking out of the open range on the upside in the DAX in this case. So I just give you probably here a chart. Where do we have it here? So what you can see here is the open range. So what I, for example, do is I do this purely manual. That means I define the open range here every morning myself. So I have no indicator doing this for me, even though you can use one. And by the way, for the US market opening, I'm using one in the MetaTrader here. But in case of the DAX, I'm doing this manually. I've done this for a couple of years now. And I'm always using the same colors and everything. So I got used to it, and it gives me a certain feeling for the market already. And sometimes, for example, I vary the open range, by the way. So I say, well, this is not a significant point here, but it's just looks like a coincidental move of the market. It was moving up or down, and that's why I don't consider this to be significant here. But so let's look at what happened in the DAX in the morning. So we had the breakout here on the upside, but I told the audience that I didn't buy this break here on the upside. But in fact, I was saying, well, I bet on a fake out here on the upside. And I'm more of the opinion that the market will move down from here, even though I didn't short it from here, unfortunately, since when I finally decided but when I said, well, I wanted to go short here, I nevertheless somehow had the idea that the market will probably test the highs again and then move down from there. So that would have been my short trigger. Unfortunately, the market just went down here. And the main reason was that I looked at the dominating time frame, and here at a very strong resist on the upside, I'm making a topic for several days already here between 12,500 and 550 points. And that was the main reason why I said, well, I'm not really willing to buy breaks out of the open range on the upside here, even though, for example, you can say, hey, so if we use this filter here, so in this case, it's the 200 EMA, on a 5-minute time frame, and we're trading above this, this is usually saying, okay, we favor long setups here instead of short ones. And so this is usually saying, okay, then we definitely go for the long, not for the short side. But here then I said, well, the potential on the upside is definitely limited. If I look at this strong resist here between 500 and 550, well, the chances on the upside are limited to, let's say 40 to 50 points here. And if I then trade a breakout here, if I get lucky, I get a risk reward of 1 to 2. And that was one of the reasons why I didn't like this breakout on the upside. And on top of that, thinking, hey, there's so much potential on the downside, especially if we move lower from here, probably anticipating a break of the lows here from last week, that I just said the risk reward on the downside is much more attractive. Unfortunately, the market didn't break lower, but here's another thing. So people asked me then in the morning meeting, hey, and now you're going short right now. And I said, to be honest, if I listen to my gut feeling, and I, by the way, look at what Stefan just will present to you here from a statistical standpoint. If I look at the volatility in the markets right now, if I combine all this, I just don't think that we can move significantly down from here. There's also something statistic in it. So what I said is, look at the DAX and the average trading range here for the last 10, respectively 20 trading days. So it was 117 points on average. And the market already moved 96 points from the daily highs to the daily lows here in the first 2 hours of trading. So from 7 a.m. GMT? No, it was 6 a.m. So this is London time here. So 7 a.m. London time till 9 a.m. London time. First 2 hours of trading, nevertheless, is right. So the market moved already significantly in its trading range. So if I look at those numbers here, then I say, well, usually this trend will continue and the market won't see a more significant move above those 120 points here, even though there might be, I don't know, a trading range then of 150 points or something. So probably some further potential of 50 points on the downside. But this is also something, if you really know what you're looking for in your trading, then you say that's probably not enough. But usually I'm trading breakouts, or I anticipate breakouts, and then I try to trade a developing trend out of this. So this is another component I'm usually using. So when I'm saying, for example, that the market is range bound and very choppy, and I don't see such a trend developing, I usually work with take profit levels. While if I see this potential, especially if we're trading at a very significant level and the market is about to break out of a certain range and above or below a certain level, then I tend to work with an intraday trend following strategy and not working with a take profit, but letting such a trend develop here. So all this, if you combine all this, you can already get a certain feeling of what I'm talking about if I'm talking about this discretionary touch here. But the overall setup is something for the Dow Jones and S&P in this case here, where I define an open range between 1:30 p.m. and 2:15 p.m. GMT. So if I look at the MetaTrader 4, then it's 2:30. No. Yes.
It's 2:30. Yeah.
Yes, it's 2:30 till 3:15
because
p.m.
of summertime, so that's the reason.
Exactly. Yes. Yeah. BST. So, but if we're working with GMT here, then it's 1:30 till 2:15 p.m. And then you trade the break of this range in direction of the identified advantage. Usually you do this. Depends on the discretionary touch, as already described. But usually what you do is you put the stop above or below the high and low of the range, and then you go with the breakout in direction of the identified advantage. And that's, by the way, the setup here. And how you identify the advantage, this is something already described in one here. So there's one chance by doing this with Dow theory. So in Germany, we call it Markttechnik. So it's very simple. For example, let me show you this here. Very, very rough. But so usually you say, well, I have an uptrend if I see higher highs and higher lows. And then what I usually do is, if I see such an extension here on the upside, I call this the distribution area. So usually the risk reward is getting unattractive here, especially for those traders dominating me. So this is, by the way, the time frame above the one I'm trading in. So if I'm trading a 5-minute chart, then I'm looking here at the 1-hour chart. So this is 1 hour. And if I see such an extended, oh, by the way, that way.
Oh, we can read it.
Okay, so you see an extension here, and this might lead me to the saying that I say, hey, if you're trading here, then even though the advantage is, or should be found, can be found on the long side, well, here I'm more used to say, well, probably I prefer short engagements. Probably also because the market seems to be very extended on the upside. So also in relation to the EMA I'm using on a 5-minute time frame. So if you see a huge extension here, that's, by the way, something you can easily see here in the morning too. So such a spike here on the upside, meaning that in relation to this EMA we are using here, we've seen the market really drawing a huge gap between the current price and the EMA itself. But this is purely discretionary too. So it's more a feeling than
it's not only a feeling, I think. I call that kind of strategy a so-called mean reversion strategy. That means whenever you have an exaggeration and so you go too far away from the EMA, you call the EMA the fair price of your underlying. And that means that is a trigger to come back to that underlying. If you, for example, look within your chart, there has been other examples earlier within that chart. Whenever you have that exaggeration, then the price tends to come back to the EMA. And that is called the mean reversion trading setup.
Yeah, in fact, so what I just found out over the years was it's not necessarily important how you name it, but all in all, we are most of the time talking about the same thing, I think. So not just you and me, but every trader. So I think this mean aversion tendency or approach or strategy, I think, is something which is which perfectly fits of what I just want to describe here.
Exactly.
Yeah, so if you go short from here, or prefer the short side, or you at least say, well, I expect the demand to diminish here on the upside, well, then you shouldn't just you shouldn't go for or very aggressively in terms of long engagements, but instead bet that the market will rather sooner or later reverse. This doesn't necessarily mean that the trend reverses, but the moment here we are going higher from there, we still have an upside structure. It's an uptrend, and nevertheless here in this region probably, and once the market shows such kind of extension here, well, then you usually tend to prefer short engagements or trade the long side with a reduced position size here, and try to make sure that once you don't have the advantage on your side anymore, that you then say, well, I try to, if I lose now, and the chances that you're losing, that the probability of losing increases to some extent if the market is really extended here on the upside, then you just try to make losers small, while, and this is the other side, let me go back here, if the market comes back to such an area, which I'd call accumulation phase or something. So when market participants in the dominating time frame start to accumulate a bigger position, then you just try to say, okay, I'm going aggressively, more aggressive long here to make sure if the market now really tends to go to those highs again here and probably break those highs and forthrighting this upside structure here, well, then you try to make your position as big as possible in terms of the risk and money management plan. Sure, you have to be aware of the risk all the time, but to make sure that the average winner here is increased significantly, and that way resulting in a higher profitability in your overall trading. And that's something that you can then see here. By the way, this is a German chart. I just forgot to adapt it here, but I will, by the way. So right now I'm translating my online educational course here. I right now just offer in German. I translate it to English, and it won't take that long that I have those graphics here translated into English too. And so this is already some, nevertheless, I think some very important weapon here in my discretionary arsenal, let's call it. Look at the dominating time frame you traded. So meaning if we're trading a 5-minute time frame, well, we have 1 hour as our dominator, and then we look at where we trade, accumulation or distribution area. And if we are in the accumulation area, we aggressively trade in direction of the trend here in our time frame. And if we're in the distribution area, it depends, but anti-cyclical setups will be definitely considered. So now let's put this here at the current situation of where we're trading it and the S&P. And by the way, I just showed to you the whole approach. So what I do is here, first of all, what we want to have here is the, by the way, 10th, yeah. So we have the day before 2:30 BST. In our case, it's 3:30, so it's Central European time. And then we look here. This is, first of all, this is the spot market I'm trading in. So I take out all the overnight trading taking place in the S&P or in the US equities in general, since the volume here is too thin to consider such moves to be significant. But this is also a discretionary approach and worked quite well for me over the time. Could be that this is then overruled by someone like Stefan, who says it doesn't really matter if you take this into account or not. But it worked over the years for me, and so I'm going with this approach. And during this time, I take the daily high, I take the daily low with the green, and here the daily low with the green line, and the daily high, the spot high with a red line. And from here, I then say, okay, I have a deep blue line showing me the close of the day before, and we have to wait until the market opens here to then put this turquoise line here at a relevant level. And then we do the same here for today. So, and now we say, okay, this is our trading range, and from here, And when we have then the market open, we then wait the first 44 minutes to have an open range here, the high and the low. And based on this, we'll formulate our setup. So since we only have time till 4 p.m., I'm sorry, not 4 p.m., it's 3 p.m. BST, respectively 2 p.m. GMT, we won't have the open range defined here when the webinar ends. But nevertheless, what we can already do is we can switch over to the hourly chart and see where's the overall advantage. So meaning, which direction do we want to trade in? And if you look at what's happening right now, we can see the volatility. I won't look at the VIX right now, but volatility is coming down. So overall, market conditions are very calm, and the overall picture is, let's say, choppy in the hourly chart. So you have some tendency that there is some bearish momentum in the market with lower highs, but the market fails to make significant lower lows here, showing that the overall tendency is definitely very choppy. Nevertheless, what you can see is that the market, as already said, has a tendency to drop lower, meaning from this perspective, very rough set, I definitely favor short engagements today. So this is also something which is underlined by, oh, by the way, let's go to the 5-minute chart before and save this. This can also be seen here if you look at the Dow Jones, for example, showing still some tendency of a bearish divergence here developing. So the market somehow losing momentum on the upside, topping out a little. And this lets me come to the conclusion that I definitely favor the short side here. And so for further information on this approach, and by the way, I'll write this setup down then for next week. We'll have a look at how this setup worked out, if it worked out at all. And Stefan will hopefully give us some statistical input then, which will show that we traded on the side of the edge, let's call it. And
And your preferred underlying is the S&P 500 or the Dow Jones?
I prefer the S&P. I somehow prefer since the S&P is it covers a broader range of assets, and if the S&P moves, I consider this to be more significant than the Dow Jones because of the 500 assets or shares in the S&P, and only 30, even though blue chips, but 30 assets or shares.
I'm 100% with you for that kind of setup. My preferred underlying would be S&P 500 as well. The Dow Jones shows a little bit, let's call it a little bit higher volatility. But for this setup, it might mean that we have more fakes. And so we have only a short move, like the DAX today in the morning. You have a short move to one direction, but not going far enough to be really profitable. So the S&P 500, I would be, is my favor here as well.
That's, by the way, the same thing I'd say for the DAX here. So the DAX tends to, well, if it moves really aggressively, even though it comes back in the same aggressive style as it moved in your direction before. So sometimes you have to be really fast in terms of the profit taking if you're just going for the movement and not for a trend developing or something, especially in choppy ranges. So that's probably not just something you can see in the Dow Jones, but also in the DAX. By the way, the DAX and seasonals, I think you prepared something for us here.
Yeah, I will take over, but there's one question within the chat, and that is related to the DAX, and then I will take over. The range times, you mentioned 9 and 10 a.m. standard German time. Is that correct?
No. In fact, I'm looking at 8. So the open of the FDAX at the Eurex, and then it's not so German time 8 a.m. So it's 6 a.m. GMT, and then I look at 7:05 a.m. GMT. So I'm taking out the first 5 minutes of trading since. When the market opens, so Xetra opens, there's lots of volume pouring into the market, and you get to see exactly what we just described, those choppy moves with some extensions on the up and downside by not being really significant since yeah, all market participants with all their opinions, let's say, pour into the market, so the spot market, and probably getting stopped out of positions, since we have to say that the Xetra market is just open between 7 a.m. GMT and 3:30 p.m. GMT. And so there's lots of price action taking place during those hours of trading in the, well, I think we should call it OTC market then. See, even though it's not really OTC, but there's also Frankfurt, and nevertheless, the volume drops significantly after that. And so that's the one reason I wait for 5 minutes here until I then formulate the open range.
Perfect. Yeah. So yeah, that was a question. So you use the FDAX time frame, and that opens at 8 German time. Great. Yeah, let me see. You mentioned seasonals already, and hopefully I get my screen up and running. Let me see. So Jens, maybe if you see my screen, just say yes.
So not yet. So right now I still see I can see your face.
You can see my face, but I think only as a picture. Let's see. So no,
yeah,
now that's
there we go.
There we go.
Yeah,
that
so
means
seasonal trading, DAX seasonal trading saying, oh no, you just switch over to my screen again.
So you don't have DAX seasonal?
Not yet, no.
Okay. I
can see it now at the bottom left. So probably you go to the left of the Google Hangout, and then you should usually see the screen there. And then, oh, now you can see me. Hello.
So try again.
And now here is the screen. And if you do the same, then it should usually work.
No, it's always just going down. So let's wait a second.
So now we can see your screen.
Now you can see my slides. Perfect. So DAX seasonal. Now it works. So let's quickly go through into that kind of topic that we have seen already. I will quickly introduce in general seasonals at all, and then we go to some specific setup which is related not to the broad or the mainstream seasonals. Normally you look at for months or really seasonals like spring or autumn. No, we do something totally different. What we do today here is that we look for the day of the week. That means, do we have Monday, Tuesday, Friday, and so on? So that will finally be the setup. And I will introduce you a complete trading strategy for the DAX. And if I talk about DAX here, then indeed I do exactly the same than you, Jens. I trade the FDAX, or at least the FDAX times. That means German time, 8 o'clock in the morning, and finally at 10 p.m. So the standard trading times for the so-called FDAX. The instrument, finally, which you trade, is not that important. You can still trade the FDAX, you can trade the DAX, but you need to adapt the times of the complete FDAX range. But that will be later. But first of all, seasonals in general. Just a quick introduction to seasonals. And that slide here is a little bit funny maybe, because I called it the mother of all seasonals, and that's indeed not related to trading. The mother of all seasonals is indeed the climate itself. And what you see here is simply the weather data for where I live. In Dresden, and of course you see the temperatures, the high temperatures in red and the low temperatures in blue. And as expected, in summertime, we have the highest temperatures, and in wintertime, we have the lowest temperatures. You may ask yourself, hey, why is Stefan telling you exactly this? Now we do it a little bit more related to trading. So trading at all is always to find probability advantages. And looking to the climate here of Dresden in Germany, we can find those probability advantage very easy. If you asked now in July, what might be the temperature for tomorrow, I would not answer 0 degrees Celsius. Why? Exactly because of that graph. Because we see here that the average temperature in July is 25 degrees Celsius. So we use that historical data, that historical seasonal, as which helps us to predict the temperature for example, for tomorrow. As I know that sounds quite easy, but that is the meaning of seasonals at all. Even if we now go on further to trading, what we try to figure out, is there a global or a general tendency for something at specific times, or I will later call them events, and event means in this case the months. And of course in summer times the temperatures are higher than in winter times, which is obvious for the temperatures in Dresden, is not obvious when we talk about trading and underlyings. But the good thing is that we can find other seasonals for trading underlyings as well. Just an example. That is the most well-known stocks seasonals you can find on websites, in the literature, wherever. And that is called the Dow Jones election cycle. What does it mean? You know that every 4 years we have elections in the United States, and then we divide those 4 years in 4 years: the election year, the post-election year, midterm, and the pre-election year. And what you can see here is simply the normalized average behavior of the Dow Jones for the last 100 years. So what we can see is that in the third year after election, there's definitely no bias for the Dow Jones. But for example, starting the pre-election year, there's a good bias to the long side for the first half of the year. And those kind of informations are simply called seasonals in general. And you may find other statistics, other statistics here, but for example, the pre-election year is the strongest one you have. And nevertheless, I emphasize the midterm year here, because even to say there is no preferred direction might already help your trading activities. In general, looking for seasonals like this, and even for seasonals during the year, there are sayings in Germany like sell in May, go away, and stuff like that. There's one general thing with all those seasonals: they have a pure or weak statistics. In this case, the Dow Jones indeed has 100 years, but if you try to figure out movements for the last 20 years according to the months of the year, then you encounter always that you have a weak statistic. You have, for example, if you look for the last 20 years, then you have 20 times the months January, and 20 times is not that huge. So that's the problem with seasonals in general. Therefore, we have to look for other seasonals with more statistics, so more points we can investigate. And before I go for that with the DAX, just once again, so the general method of seasonals is looking for patterns, like you remember the temperature versus months for Germany. If you find those typical patterns, then you can try to use them. But you might look for other events or other seasonals, like the month itself, or maybe the day of the month, which is interesting, I can tell you, because, for example, at the beginning of the month, big font companies, big investment companies may position themselves new. And therefore, we have some good movements always at the beginning of a month that you can prove by statistics as well. You can go further down the road of the different time frames, and we will look for the day of the week. But even going down to hours, then we are close to what Jens has already presented, like open range breakouts. Even that you can describe from a seasonal standpoint. That means that you have a specific point in time when volatility goes up, when breakouts might happen, and that is a seasonal over the day. And there are reasons why Jens told us that he has, for the DAX, he uses the first hour and a little bit more for the DAX, or the first 3 quarters after US stocks market opening. In general, the assumption is things we can observe in the past, they will repeat, and that is exactly what we try to use in our trading. So now, for me, the question is, do we have a correlation between the day of the week, like Monday, Tuesday, and so on, and a certain direction for the DAX, maybe long or short? And you will see the answer is a little bit more complicated, but not that complicated. And I can directly go here in my investigation. And by the way, that is simply Excel based, so everybody can do that kind of investigation. Underlying here is the FDAX. So I started with FDAX numbers starting at nearly 2000, so 1 year earlier. And then the first thing I figured out, or I investigated, was simply the volatility itself. That's not already the answer to our seasonal question, but at least since we have the data, since we look already for the day of the week, let's have a look to the overall volatility with respect to the day of the week. And obvious answer is, nah, there's no big relationship between the day of the week and the volatility. It's always around 2% move during the complete day, 2% between maximum and minimum. And overall, yeah, the Thursday has the highest number, but anyhow, the differences are quite small. So we don't have a volatility correlation to the day of the week. But the interesting thing now is, let's go for the FDAX and draw one EMA within that FDAX. And since the period here is nearly 20 years, you can't really see the red line. The red line is an EMA. And that EMA in this case is an EMA of 40, but I can change it, and then it would change the picture here. And I use that EMA only for one reason. I want to have a quick and dirty, but good definition of a bull market or a bear market. That means I simply want to differentiate between bull markets and bear markets, because I think there is a relationship between day of the week, then the market, overall market condition, bull or bear, and then the day of the week. And going not really through that Excel sheet here, how the analysis is done, that is an important final result. Let me describe exactly what you can see here. So let's start with the bull market. So bull market is defined that the price is above EMA, the EMA 40 in this case. And what we can see here now is in average on Mondays, yes, in a bull market, the market goes up. Same is true for Thursday and Friday. So in a bull market, yeah, Monday, Thursday, and Friday is a good day to place a long trade. But, and now the astonishing result is, Tuesday is a reverse day. That means even we are in a bull market, in average on Tuesdays, the market went down. And the funny thing is, if we now look for the bear market situation, so when the price is below the EMA, then we see exactly the opposite. So Monday is slightly in line with being a short market, but even in a short or bear market, on Tuesday, we should open long trades. So, and the same is true for Wednesday. Thursday and Friday, once again, are normal days. That means, yeah, we are in a short market, and on Thursdays and Fridays, we can go short. But same story here. Tuesday and Wednesday are reverse days. So, and now it comes to trading. So what we want to have is, we want to look, hey, maybe we can simply trade that idea completely automatically. So following exactly those rules here, we look for the relation between current price and EMA. We look for the day of the week, and then we know what kind of trade we should open. And that's what I have done here within that Excel sheet, that following exactly those rules, I open always a trade at the opening of the market. And then finally, I get an equity curve for that kind of strategy. And that for the last, nearly last 20 years. So finally, the rules, I will summarize on a separate slide. But the good thing is that if you investigate such a strategy, and if you have such a statistical edge on your side, like the day of the week and the overall market condition, then we can simulate all our trades, and then we can have such a simulated equity curve. And finally, we can even change, for example, the EMA a little bit, for example, to 45, and then you see, oh, it's getting a little bit better at the end, but at the very beginning of our historical data, it's getting worse. So you can balance a little bit what kind of EMA you want to have. And finally, of course, every trade needs a stop loss. And that stop loss here is simply defined in %, which is the correct definition here, because, you know, today the DAX is around 12,000. There have been times the DAX has been at 3,000. So we definitely need a percentage value, and not a value like 30 points. And then we can create completely the strategy, and we can simulate all our equities. So I will present you two other things here. One, back to the complete rules of that setup, because then everything should be obvious. So what we really do is that we compare at 8 a.m. German time the open price of the FDAX with the EMA value period 40 of the previous day. And that comparison defines a bull or bear market. And now it's up to the day of the week. Monday, Thursday, and Friday are normal days. That means in a bull market, we open long trades, and vice versa for short. So, of course, our trade has a stop loss, and this is set to 1.1% of the open. And all the trades we generate by that kind of trading setup are either closed by the stop loss or at 10 p.m. in the evening. So when before market close, we close the trade. We don't have to take profit for that setup, and then we are already done.
Stefan, one thing. So 10 p.m. in the evening, you just said. So this is German time. So meaning 8 p.m. GMT in this case. Just
absolutely.
To avoid any, yes.
Yeah. So because I know it's sometimes a little bit complicated with all those times, and depends a little bit where you live, and GMT with summertime, without summertime, and so on and so on. The best thing is that wherever you live, you try to figure out in your local time the open time of the FDAX and the close time of the FDAX. And those two points in time are exactly those we use here for that specific strategy. So it's open time of FDAX and close time of FDAX. Wherever you live, it should be related to the German time as well. Good. And that you see that is a quite simple strategy in terms of how many degrees of freedom does that strategy have? Only 2. It's the EMA and it's the stop loss value. So that's only two parameters you might change. But the good thing is it does not really depend on those details. So if you go for a little bit other EMAs, if you go for a little bit other stop losses, it will not change the overall picture of that kind of strategy. And that strategy, even the history is quite long, I presented in the Excel sheet, is, for example, traded here on a JFD account. And it's not that long. The strategy runs here since the 1st of June. And you see now here the MT4 for that kind of strategy. And let's first ask ourselves whether everything is right. What you can see here is a daily chart of the DAX. And we have a red line here that is a EMA. And today's situation in the morning has been price has been below the EMA. So we are in a short market, but today is Tuesday, so it's a reversal day, and therefore a long trade has been opened at 8 o'clock German time. Okay, you see that the trade which has been opened, we are exactly at the same price level as we speak. So it looks like today there will not happen much to the upside or to the downside for the trade. But a long trade is right for today. And I can already say for tomorrow, it will be a long trade, most probably once again, because we are in a short market, but Wednesday is a reversal day as well. Therefore, tomorrow will be a long trade once again. The good thing is, yeah, we can create, even the history is not that long, we can create a report for the history of that account. And let's look to that. Even the history is not that long. So up to now, a little bit more than a month, the strategy has gained nearly 50 euros. The account size is 2,000. And so that's not bad. It's running well. It's exactly into the direction everybody wants to have any strategy, so to the north. And that you see the risk involved here per trade. I can simply show once again here within the chart. So the stop loss means the trade, if the stop loss would be reached, the trade would lose 14 euros, and that's all. So that is a risk here per trade at the current DAX level. So everything is right. What does it mean? Quite a simple strategy. You can adapt for yourself, and even you can use that kind of strategy in total with those rules, or you can try to use it as a bias for other trading activities, for your discretionary trading activities, for example, for the DAX. And you simply say, okay, we are in a short market. Therefore, today I would only open long trades. And even to have that kind of bias might help your own trading activities as well. And since I see now already a question here, the EMA 40 is on a daily time frame. Yeah, that's correct. It's the EMA 40 on the daily chart. So that's for me right now. And yeah, the hour is nearly over. But still, we need another 20 minutes to have Jens' strategy finally, or to be finalized. But maybe you can quickly show the current chart that we know where the range might end.
Yeah, sure. What I'll do now is 1 second. So first of all, click, 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 and here, click. Now you should see my screen. So what we can see is that in fact the S&P is coming in very choppy, very unspectacular. So here from the market open, this is now the turquoise line. As you can see, this is the open of this 5-minute candle here. So it's the first tick at 1:30 p.m. GMT in this case. And from here, we went down here, now seeing the low around 3 points below the open. So meaning that currently the open range, by the way, we now have to see, well, there was a huge, it's not huge, but the current open range is around 3 points. So what I will show you now is, this is a little difficult here, or not difficult, but it's not that nice. So what we can do is here, as you can see, there are thin red lines. So especially here, and those thin lines, they are showing the high and the low, and they are doing it automatically for the US market. So what I have to do, first of all, is here, adapt this a little. And then you can see already that the market, or you can see already the open range, and then based on that, how to formulate a trading setup. By the way, for all those who are usually listening to the morning meeting, it's a little bad what's happening in GBP right now, with Euro being Euro GBP short. So there was one member of the Bank of England who used to be quite hawkish in his statements during the last. Oh, by the way, this is not right here. So something went wrong. So here, and unfortunately, he doesn't was hawkish at all, resulting in some weakness in the GBP right now. And this market is obviously going against me, which is not a big deal since the position size is very, very low. Nevertheless, I prefer seeing the market going my direction here. So I'm talking while I present to you this chart. So here, this is right now the picture, as you can see. And here you can see that the here's the red line, here's the other red line. And this is now, or this box will end here at 3:15 p.m. British Summer Time, so BST, respectively 2:15 GMT. And yeah, based on the overall advantage we already formulated here at the beginning of the webinar, what we'll do is we'll go short with a break of this open range here on the downside, currently lying at 2,422.5. Yeah, and that's it, in fact. So if we are triggered short, then we put the stop here above the daily high of the day, so intraday high, which would be at 2,426.5, meaning we have a risk of 4 points. And yeah, then we'll have to see what target we look for. So in fact, so in the current market conditions, I definitely prefer to work with a take profit. First target would be around 2,410 here. So if we're going short at if we're going short here with a low here at 2,422, meaning we are working with take profit around where with the target lying 12 points away from our entry point, we're having a risk reward of 1 to 3. So initial risk is 4 points. The chance, the reward, the potential is 12 points. So leading to a risk reward of 1 to 3 here. Yeah, but just let's see. I mean, 15 minutes don't seem that long. On the other hand, so markets are, yeah, but markets can move quite strong during such a short period of time, and resulting in the open range to be much wider than that. But at least so you have a first tendency in which direction a setup would go then here. Going short to 2,422, stop 426, and then the target around 2,410. Yeah,
Perfect.
So that's it from my end. Yeah.
Very good. So I think hour is over. I hope everybody enjoyed the webinar. See you again, hopefully next week. And if there are any questions you have seen within our slides, you can contact us every time via email, for example. So don't hesitate. So I wish you all the best. And so the final word is for Jens.
Yeah, nothing more to add from my end. So much appreciated that you took the time to listen to us. And yeah, as Stefan already said, next week on Tuesday, we'll have a deeper look at the statistics here of this strategy I just presented to you on the open range breakout. And yeah, so that's it from my end. So have a nice day. Happy trading. Watch your stops. Talk to you again next week. I look forward to it. Stefan looks forward to it. See you and bye-bye.
Bye-bye.